Good afternoon and welcome to the webinar on the topic Simple Way to Calculate Break-Even Point for All Your Products. Friends, this will be the last webinar for 2016. Saying so, I would like to make sure that you get the best out of it. And I'm not saying this will be the end of the webinars that we'll be conducting along with Smart Connect Forum. There are many webinars planned and lined up starting in the month of January 2017. So let's get started with this particular webinar. First things first, I would like to make sure my voice is audible. If my voice is audible, please say yes in the message box. Thank you. Good to know some of you can hear my voice clearly. Also, if you have turned on some of your other devices like your laptop or mobile, which might be using the Wi-Fi that you might be using to stream this particular webinar, please make sure that you turn them off. Otherwise, the picture, the screen will be looking very blurry. Okay, good. People are giving me a thumbs up saying that you can hear my voice clearly. And just from my experience, what I have found out is sometimes the image will look bit blurry. However, just wait for a few more minutes, it will get all right. This is from my experience. Now that we have tested the audio and the video, let us do a quick warm up and let us test our counting abilities. How much is 1 plus 2 plus 3 plus 4 plus 5? I'll give you 5 seconds. Quickly add the numbers 1 plus 2 plus 3 plus 4 plus 5. And the answer is it 14 or 15 or 16? Let me give you a hint. It is an odd number. Yes, friends, the answer is 15. Just making sure that you're present and you are all set. Now let us keep the webinar rolling. This is something that my lawyer asked me to show you, and this is something that I always keep showing at all my webinars and seminars. The gist of it is this particular webinar is for educational purpose. Whatever decision that you will be making in your business will be responsibility of your decision. That is all this particular slide says. Okay, let's get started. Good afternoon and welcome to the webinar on the topic Simple Way to Calculate Break-Even Point for All Your Products. I have broken down this particular webinar into 3 sections. The agenda of this particular webinar will be to answer 3 questions that you will be seeing on the screen. The first one is to understand the terminologies break-even point, contribution, fixed and variable cost. You might have heard these terminologies used by your accountants or CFOs or other financial experts. I will be breaking down each and every terminology into simple layman perspective using examples. The second part of this webinar, we will be learning how break-even point is actually calculated so that you can use that particular formula and immediately implement in your business as soon as this webinar is over. And the last part of the webinar will be addressing this question: are you selling the product or service in your business for profit? And again, this will be explained by using a case study. So let us start with the first part of the webinar, which is understanding the terminologies. Break even point, in short, people will also call it BEP. The general definition that you will find on Google or on any accounting books, the general definition of break even point is level of sales necessary to cover all variable and fixed expenses and neither make a profit or a loss. Friends, according to me, this common definition is a bit flawed. Let me tell you why. According to me, the definition of break even point should be level of sales necessary to cover all variable and fixed expenses plus an amount for profit. What is the point of just breaking even in business if you are not making a profit? This is the reason I keep emphasizing, and I make sure that my clients that I work with, I make sure they add a percentage for the time that they are spending in their business in form of rewarding themselves in form of salaries, and on top of it sometimes commission, and on top of it certain amount of profit that has to be included along with fixed and variable expenses. Now you might think, what will happen to the profit that business will be making after that? Well, that should be like a bonus. This should be the mindset when we enter the business, or else I'm sorry to say we will be working really hard just to pay the bills, just to make sure that we pay the rent to the landlord, just to pay the salaries to the employees, and somehow make sure that we pay all the bills and we go back home empty handed. Now, this particular definition that I just told you about break even point has got some keywords. The keywords are variable cost, fixed cost, and profit. Let us understand each and every keyword with an example. Now, imagine you are or you have started a burger shop, a fast food shop, and you sell burgers and fries. What do you think will be your major expenses in this business? Or even before that, let me give you some more picture of this particular example. You are owning this fast food shop which sells burgers and fries, and the business makes money by selling burgers and fries. Now let us see how the transactions will be recorded on profit and loss statement. I see some, like three or four of you haven't uh, attended any of my webinar and have got quite a few regular webinar attendees. For people who haven't watched my presentation before or haven't seen or read any of my articles, I would like to break a misconception people have around the subject business finance. They think it is beyond the scope of understanding and they think it is really complicated. Friends, let us break that misconception, because when it comes to business finance, there are only four things that can happen. Only four things: money comes in, money goes out, money is supposed to come in, and money is supposed to go out. Nothing in any business can happen outside these four financial transactions. Saying so, what do you think are the main expenses that you would incur running this burger shop? Quickly send your type in the message. Yes, Ron is saying food materials. I would say ingredients. Yes. Suzanne is saying rent, salaries. Yes, I agree with you. Electricity bills, telephone bills. Thank you. Thank you for participating. Yes, friends. Pretty much whatever you said can be included as expenses, can be considered as expenses. Some of them are ingredients, which might be bun and bit of meat and vegetables and potatoes to make a burger and fries, salaries to the employees, rent that needs to be paid to the landlord, interest on loan. If you have taken a loan from the bank, then you will have to pay interest every month. That is considered as an expense. And also takeaway cups and boxes. When you make that burger, you usually serve it on a plate or a box, or you put the fries in a cup. Even that is considered as an expense, cost that is incurred for the business. Now, whenever this particular shop sells a burger and fries and money comes into the business, it would be recorded under sales as incomes. Incomes, money comes in. Under under the section incomes, you can see sales, and also you can see other incomes. The difference is, if this shop makes money by selling burgers and fries, the money that comes in by selling burgers and fries would be recorded under sales. But sometimes in business, people in business make money outside its core business activity. For example, in this shop, if they rent this particular shop for a birthday party or for some kind of a small family function, still money comes in, and that should be recorded under other incomes, simply because this burger shop was started to sell burgers and not to rent and have parties. I'm not saying that you should not say no to opportunities if people want to rent this particular place to have their family functions. What I'm trying to say is, please make sure all the transaction where money comes in is clearly divided under sales and other incomes, or else if everything is mixed, then it becomes very difficult to understand if this business is really making profit by selling burgers or not. Now, the simple definition of profit is incomes minus expenses. If income is more than expense, then accountants will say this business has made profit. If expenses are more than incomes, then accountants will say business has made a Rachel just typed in saying that business would have made a loss. Well, Rachel, accountants are optimistic people. They don't use the word loss. They call this business has made negative profit, which is nothing but a loss. Now, let us break expenses and call it as fixed expense and variable expense. Variable cost or variable expense are costs that varies as the sales vary. So whenever sales increases, the cost that is required to manufacture that, produce that particular product will also go up, and that is called as variable cost. It varies along with the sales. Whereas fixed cost are costs that will remain fixed irrespective of whether sales increases or decreases. So expenses, we have divided it into variable expense or variable cost and fixed cost. Now, with few expenses that we can see on the profit and loss statement, let us separate it as, and let us see which is variable cost and let us see which is fixed cost. Ingredients, is it variable cost or fixed cost? Please type in VC or FC in the chat box. Yes, all of you are getting it right. It is a variable cost, because whenever sales increase, in other words, whenever If this shop is selling more burgers, definitely you need more ingredients to make that burger. So it varies along with sales. So ingredients is a variable cost. Salaries. Is it a fixed cost or a variable cost? Yes, it is a fixed cost. However, if commission comes into picture, then commission would be variable cost, because you will have, as a salesperson or a business development manager, you might have this incentive of getting commission if you help get more business, more sales to a business. So salary will be fixed, however commission will be variable cost, because if you sell more, obviously you'll get more commission. Rent, in all likelihood, it is a fixed cost. Interest on loan, it is again a fixed cost. Take away cups and boxes. So if you're selling more burgers, obviously you need more plates and cups and boxes. So it will vary if the sales vary. Again, friends, there are many other expenses that this particular burger shop would incur, but however, for the uh, example of this particular webinar, I'm just making sure that I'm limiting it to few expenses. Doesn't matter, you might have 10, 20, even 100 expenses. You can see it on profit and loss statement. All of them can be broken down into either variable cost or fixed cost. Sometimes you might have cost that might be both fixed cost and variable cost. As I told you, various heads of expense can be classified as either variable cost or fixed cost. However, some expenses will be partially variable cost and fixed cost. Now, the general definition of profit is sales minus expense, and we have broken expenses into variable cost and fixed cost. Now, I would like to introduce a term called contribution. Contribution is nothing but whenever a sale is made, how much does that sale contribute to the business? That is what contribution is all about. In other words, contribution is sales minus variable cost. I repeat, contribution is sales minus variable cost. Let us go back to the example of that particular burger shop. Let us imagine you are selling one burger for $25. So you charge $25 to the customer who buys one burger. Again, as I told you, this is just an example for us to easily understand through easy calculation. So cost of one burger is $25 to the customers. Now, let us imagine the ingredients, which is the variable cost that is required to make a burger, is $10. So $10 is what it costs to the business to make one burger. Contribution is sales minus variable cost, which is $25 minus $10, which equals to $15. This $15 is the contribution made by selling one burger. Any questions so far? Cool. Philip is giving a thumbs up, and I thought Rachel was typing something, but it's all good. Okay, let me continue. Let us go to the second part of this webinar and understand how break-even point is actually calculated. Now that we have understood a bit of terminology in regards to break-even point, contribution, and we know, I hope that you have understood the difference between fixed cost and variable cost, let us understand, let us learn how break-even point is calculated so that you can immediately start implementing it in your business. Now, as I told you, various heads of expenses can be classified as either variable cost or fixed costs. We just learned contribution is sales minus variable cost. Adding on to that, profit will now become contribution minus fixed cost. Friends, all I'm doing here is splitting expenses into variable cost and fixed cost. And we have just taken variable cost into picture when it comes to contribution. So contribution is sales minus variable cost. Now contribution minus fixed cost becomes profit. Please let me know if I'm going too fast. I'm happy to slow down and feel free to ask any questions along the way. I'll make sure that I'll answer it right away. All good? Awesome, good to know. So contribution is sales minus variable cost. And when that contribution is subtracted by fixed cost, we will come to know whether a business has made profit or a loss. Again, let us go back to example of the burger shop. Let us call it Melbourne Burger Shop. I'm not sure if that domain name is available, but anyway, I just came up with it. I hope no one will sue me for that. As I mentioned before, cost this business incurs to make one burger is $10. So ingredients will cost this shop $10 to make one burger, which is the variable cost. Let us imagine the rent is $1,000 for 1 month, which is the fixed cost. Now they are selling each burger at the rate of $25. So cost of one burger for the customer is $25. So quantity sold is one burger, which costs $25 to the customer. Now cost of making one burger is $10 to the shop. Contribution is sales minus variable cost, which is $25 minus $10, which equals to $15. Fixed cost will be fixed, which is $1,000. So this business, if it sells only one burger in that particular month, it makes a loss of $985. That's why it is in brackets and it is in red. Obviously, this will not be a profitable and a sustainable business if it just sells one burger. Let us see what happens if it sells two burgers. The sales has now doubled. So it is $25 into 2, which is $50. Variable cost has varied along with the sales, as because the sales has doubled, the variable cost has also doubled. Contribution is sales minus variable cost, which is $30 in this case. Fixed cost remains fixed. As I told you, the definition of fixed cost is it remains fixed irrespective of whether sales increases or decreases. Now, this business has made a negative profit of $970 by selling two burgers. Friends, I would like you now to calculate and quickly tell me how much profit or loss this business will make if it sells three burgers, and how much profit or loss will this business make by selling 10 burgers. Quickly take a paper and a pen. Some of you who are used to my webinar know that it will be an interactive webinar where I will be asking you to do simple calculation. Now, there is a beautiful Chinese proverb: I hear, I forget, I see, I remember, I do, I understand. So I make sure that in my webinars and seminars, I actually make the participants do something so that they get used to it. Otherwise, this would be another lecture that you might just hear and go, wow, and forget it. Okay, what would be the answer? Awesome, some of you are getting the answer right. Do you need more time? Well, friends, I would love to give you more time. However, I need to make sure that will I should be able to finish this webinar by 2 o'clock. So I will give you the answer. Now, when it comes to three burgers, if this business sells three burgers, cost of each burger is $25. So 25 into 3 is $75. Variable cost will vary. So it will be $10 into 3, $30. Contribution will be 45. Fixed cost will remain fixed. It will not vary. And now this business has reduced the loss to $955. When it comes to selling 10 burgers, it would be sales or revenue will be $250. Variable cost has varied along with the sales, which is $100. Contribution is $150. Fixed cost will remain fixed, so it is $1,000. So this business has further reduced. Oops, it is a bit of a typo. It is not $850. It is actually 940. My bad. So it is actually $940. Now, friends. Oh, I was right. It was not. Anyway, let's just ignore that particular mistake that I made. It was all right. I thought it was four burgers. Now coming back to what I was saying, break-even point. The business has made a loss because the amount of contribution is lower than the amount of fixed cost. I repeat, let me go back to that particular slide. I made that mistake. It was correct. It is $850. So this business has made a loss of $850 because the contribution is less than the fixed cost. So if contribution is less than fixed cost, business makes a loss. When contribution equals fixed cost, that is when the business breaks even. When contribution is more than fixed cost, business has made profit. So the formula for break even point is fixed cost divided by contribution per unit. Friends, if there is one thing that I want you to really understand and take away from this particular webinar, that would be this particular slide. Understanding and remembering the formula for break-even point. Break-even point is fixed cost divided by contribution per unit. Now, for us to really come up with an accurate figure for break-even point, we need to know what is the total fixed cost for your business. Not only that, we need to know the contribution. To know the contribution, we need to know the variable cost for your business. And you have to subtract that variable cost with every sale that is made. When contribution is less than fixed cost, business will make a loss. When contribution equals fixed cost, business has broken even. If contribution is more than fixed cost, that is when business starts making profit. So formula for break even point is fixed cost divided by contribution per unit. Any questions so far? Shall I continue? Okay. Uh, Philip wanted me to go back to that particular slide. Yep, you can take notes. If you want, you can take a screenshot and revisit it later. Uh, Sorry, Sarah. I don't share my slides. It's an intellectual property. However, you're free to take notes. Okay, let me continue. So break-even point is fixed cost divided by contribution per unit. Going back to the example of Melbourne burger shop, fixed cost is $1,000, which was the rent. Contribution per unit was $15, which we calculated for. So $15 per burger is the contribution made whenever one burger is sold. Now let us calculate break-even point. Fixed cost divided by contribution per unit. So $1,000 divided by $15 equals 66.66, which means when 67th burger is sold, business makes profit. Let us look at the numbers. These are the numbers we calculated. Of course, we could have continued after 1, 2, 3, 10, 20, 30. That is not a very effective way to find out break-even point. So we have understood this particular formula, and using that formula, we found out the break-even point is 66.66. In other words, when the 67th burger is sold, business makes a profit. So here, this business, when it sells 66th burger, still it makes a loss of $10. However, when the 67th burger is sold, business starts making a profit. And with 68, the profit goes on increasing. Friends, I know some of you might look at all these numbers and you might think it is too overwhelming, but just relax. All you have to understand is this particular formula, which is break even point equals fixed cost divided by contribution per unit. Again, as I mentioned before, to calculate contribution, we have to know how much is the variable cost and how much is the fixed cost. Once we know the contribution every sale makes to your business, then it becomes easy to calculate how much you should be selling. Now, for this business, let us say that they want to sell 200 burgers. That is their aim. If they have to sell 200 burgers, naturally they have to have customers who will buy those 200 burgers. Let us say if one person buys one burger, then they need 20 people to 200 people to buy to walk into the shop. If 200 people have to walk into the shop, it simply means that at least 500 to 1000 people should know about this particular shop. If 500 to 1000 people are made, if they need to be made aware of this particular shop, at least 2000 to 5000 people should somehow hear about the shop through marketing. Friends, if you can carefully listen to what I'm trying to say, these kind of numbers, by understanding the break even point, it becomes easy. Well, I wouldn't say easy, it becomes more effective in our marketing messages. What is marketing for? It is to make sure that customers are made aware about our product or service that we are selling. Now, how many customers should hear about this? We can't say as many as possible. As Peter Drucker said, what gets measured gets managed. So as long as we know, okay, our target is to make sure that 5,000 people watch our videos, or they watch, or we have got so many likes on the Facebook page, or we do 500, 5,000 letterboxing, it becomes more and more effective. Anyway, I'm slightly deviating from the topic, but the reason I mentioned that is the intention behind finding all this break even point will help us to make sure that our other marketing expenses can also be tracked accordingly. Now, let us understand it by through a graph. Break even point. We have variable cost, which varies every time sales increases. We have fixed cost. It is fixed. That is why it is horizontal. Now, variable cost plus fixed cost gives us total cost. Let us imagine this curve to be total sales. Of course, every business owner will be jumping on the roof if they see the graph increasing this way. As I told you, this is only for the sake of the example. Now, if this is the total sales for Melbourne Burger Shop and this is the total cost for Melbourne Burger Shop, this portion, the red portion, is the loss. And as you can see, the loss is pretty high here when it started, and slowly it became less. And when it becomes zero, this is the break even point. This is where contribution equals the fixed cost. And after this, any sales made will start generating profit, and the profit becomes more and more as it moves forward. Friends, I hope this graph is self-explanatory, and this is where the profit happens. Now, for all this to be effective, we have to know what is our fixed cost and variable cost. Let me continue to the last part of this particular webinar, which is, are you selling for profit? Most of the time when I ask people, do you know how much profit, or do you know how your sales that you're busy generating is impacting the bottom line? Most of the time they say, I think I know. I think it is bringing us 10-20% profit. Well, friends, the words I think, I should, maybe, I hear it as uncertainties. You're not very clear. I'm sorry to say this, but business is either one or zero. Either you're making profit or you're not making profit. It's black or white. You shouldn't be in the gray area. Now let me emphasize on this particular point. Now let us imagine there's a person called Tom. Tom is walking on the street, and all of a sudden he sees $1,000 lying on the street. Tom looks around, picks it up, puts it in his pocket. So $1,000 has not costed anything to Tom. Lucky Tom. Let us imagine Tom has got a friend called Nick. For some reason, Nick needs $1,000, and he approaches Tom and says, "Hey Tom, can I borrow $1,000 from you? I will pay 10% interest." Tom knows if he keeps $1,000 in his pocket, even after 1 year, it is still going to be $1,000. On the other hand, if he gives $1,000 at the rate of 10% to Nick, after 1 year, he will be having $1,100, provided Nick pays and Tom collects. Now let us imagine Nick has got a friend called Harry. For some reason, let us imagine Harry needs $1,000, and he approaches Nick and offers to give 5% for the $1,000. Do you think Nick will say yes? Most of all of you are saying no, 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 no. Obviously, Harry, Nick will not give $1,000 to Harry at the rate of 5% because it is costing him 10%. Now, Harry will again approach Nick, and this time he offers to pay 10%. Nick is like, it, I'm not running a charity here. Obviously, I'm not going to give it for 10%. Nick might take into consideration to say yes if Harry offers to pay him anywhere minimum 15 to 20%. Friends, it was so surprising and shocking when I found out most of the businesses that fail are businesses where people were giving $1,000 for less than 10%. Now, whenever I share this, people immediately ask me, how can they be so stupid, Chinmay? It is not about stupidity, it is about ignorance. Friends, let us not get caught up with $1,000 and 10%. It is just numbers that I have used to make a point to explain this particular thing. As I told you, it is not because of stupidity, it is because of ignorance. People have ignored numbers and they think it is their accountants and bookkeepers and the CFOs who should be bothered about it, and they end up making decisions based on assumption. If their assumption happens to be right, then business ends up making some profit. If the assumption happens to be wrong, I'm sorry to say, most of the time business will be struggling to pay the bills and very soon they will be out of business. Now, let us get rid of Nick and let us replace Nick with your business. Or in this example, let us have Melbourne Burger Shop here. Now, this particular shop has borrowed money not from one person. It usually it borrows from three parties. One, it borrows money from insiders who are none other than owners, investors. Most of the people, this is one of the common mistake most of the people make in business. The money that they have invested in their business, they do not associate a cost to it. They think that money is free. Of course, the business is not under any obligation to pay it immediately. Usually it is more than one financial year. Because there isn't any obligation or there isn't any deadline, most of the people in business think owners' money is free. Friends, please understand, owners' money is not free. In fact, it is one of the most expensive source of money. Well, I can't emphasize more on that point or explain more about that particular point. I would suggest you to read my book. That is where I have mentioned it very clearly. But anyway, coming back to what I was saying, this particular burger shop will first borrow money from insiders who are owners. Then it will borrow money from outsiders. Predominantly, it will be from a financial institution like a bank. And then it also borrows not money but in kind. It borrows product or service from people to whom it is supposed to pay, and that would be called current liabilities. Currently, business is liable to pay someone. In other words, all the money that is supposed to go out of the business within one financial year would be under current liabilities. Like the rent, business has not borrowed money from the landlord, it has taken that particular space for that particular month. So it is liable to pay rent. Now, salaries, wages. Business is not borrowing physical money from the employees, but it is borrowing their skills and talents. Employees are trading their time and freedom to which the business will pay them salaries. Same thing with bills and creditors. Creditors can be suppliers, people who supply buns, people who supply food. They would give the food materials like vegetables, fruits, whatever is required to make a burger and fries. And they will say, I will come back for my money after 7 days or 14 days or 30 days, depending on the nature of the business and how they negotiate. And they are called as creditors. Now, looking from business perspective, it has not borrowed money, but it has borrowed its kind. The key thing is, with all the borrowed money and product and service, business produces this particular product, which can be burger and fries. Is it selling it for profit? Most of the time, the answer is no. And this is what I found out with most of the businesses that has failed. Friends, for us to understand this, we need to understand numbers. We need to know how much it costs us to make a product. We need to know every time we are making a sale how much it is contributing to the business. And on top of that, we need to know the fixed cost so that we can find the break even point. And collectively, the whole team within the business will strive to make sure business is profitable. Now, have you ever walked into McDonald's and just purchased a burger? It will never happen. They'll always upsell you with fries and sugar water. Friends, burger is a way to get customers within the door, and burger takes care of most of the operating expenses for that particular McDonald's shop. Usually, the profit margin, operating profit margin on burgers is anywhere between 6 to 8%. However, on fries, it is 3 to 5 times more. And when it comes to sugar water, which costs them less than 5 cents, they are selling it at $3.50. Just imagine the profit margin that they are making. And that is how they bundle their product, and they make sure that every time they are selling something, it is more than what it is costing them. And this is all you need to know. And for that, you need to learn to speak the language of business, which is numbers. And today, I hope you have understood how to calculate break even point for your product. Let me quickly summarize. Contribution is sales minus variable cost. And when you get that contribution, when you find out the contribution per unit, then you subtract it with fixed cost. It will either tell you whether business has made a profit or a loss. And if the contribution is less than fixed cost, then business has made a loss. If contribution equals fixed cost, then the business has broken even. When contribution is more than fixed cost, this is where business starts making profit. Formula for break even point is total fixed costs divided by contribution per unit. This will help us to find out how much product we should be selling to break even. And in the very first slide, I mentioned definition of break even point should be amount of sales that is required to take care of all the fixed costs and variable cost, and on top of that, bit of profit that needs to be included so that business owner walks out of the business making a profit, or else there is no point of just breaking even, because that is not the ultimate goal of any business. Break even point is just a milestone a business should reach, the first milestone business should reach. Friends, if you have any questions, I'm open to it now. I can answer it, or else you can contact me by connecting with me on LinkedIn or visiting my website and dropping me a message, and I'll make sure that I will answer all your questions within 48 hours. It has been a great experience working and collaborating with Brenda Thompson, who heads the Smart Connect forum. You can visit their website ssba.net.au. They have got amazing materials and also experts on their panel. You can see some of them here. Francis, whose expertise is in sales, Nomika, whose expertise is in marketing, Lisa, her expertise in is in mentoring people to become effective leaders, and Liz, her expertise is in customer service. They write amazing articles and also conduct regular webinars. I would highly recommend all of you to visit this website, ssba.net.au, and tap into the resources. Even all my webinars that I have conducted so far. You can access it, you can read articles that we have written. And Brenda mentioned that very soon she will be packaging it as one big product. So I'm really looking forward and excited so that I can forward it to all my contacts. Saying so, the image that you see on the top right, it's the cover of my book, and recently it became Amazon's bestseller. You can purchase it on Amazon or drop me a message, and I'll be happy to ship it to you. It will cost $30. Friends, thank you so much. I hope this particular webinar was really informative, and as I told you, I would my vision is to make sure that everyone in business speaks the language of business, which is numbers. Please go ahead and calculate the break even point for your business, and also go and pick the brains of your accountant and ask them how break even point should be calculated for your business, and then make sure that you work smart and not just hard. Thank you so much once again. I'm sure that we will be meeting, and as I told you, this will be the last webinar for 2016. I had a great time presenting all my webinars alongside with Smart Business Connect, and we are all excited and geared up, and we have got big plans for 2017. I know it's a bit too early, but Merriest Christmas and a Happy New Year. And I wish that 2017 will be the best year for you so far. Thank you so much once again, one and all. Have a wonderful day and good luck with your business. Go and kick some goals out there. Thank you.